Welcome to the MarketBeat podcast. I'm your host, Kate Stalter, and in this show, we cut through the noise and give you real market insights from professional investors, traders, asset managers, and analysts. Our guests put the market developments in context and give you actionable information to make you a more successful trader or investor. Let's get started. So on this show, I like to address strategies for both investors and traders because both are important, and even folks with trading accounts typically also have longer term portfolios. And sometimes it's those long-term accounts, you know what I mean, an IRA, a 401k, those may get neglected because investors think of them using words like prudent. But that doesn't mean your long-term allocation should just be set and forget. In fact, that's exactly what you should not do because your account earmarked for specific financial goals, usually retirement, needs to be rebalanced and evaluated on a regular basis. And the current market downturn and volatility definitely present an opportunity for that kind of reevaluation. But at the same time, you don't want to be trading reactively and putting your portfolio at even more risk, particularly if you get too defensive and miss the next uptrend. Well, today's guest, Nanette Abuhoff Jacobson, global investment strategist at Hartford Funds and Wellington Management, addresses exactly that quandary and offers some very specific ideas on how to allocate your portfolio according to asset class, given this current set of market and economic conditions. One of the topics we discuss in this episode is the so-called demise of the 60-40 portfolio, which many analysts are saying right now. Now, in particular, Nanette and I review the role of fixed income. And yes, I know, bonds never deliver the return of stocks, and they're not exciting and fun to read about and trade. Yeah, that's true. But it's important to remember, bonds add ballast or stability to your portfolio. Over time, they serve to dampen the volatility of stocks, even though that has not happened recently, but it's over time. So that's not the only part of your long-term allocation that needs attention right now. And Nanette offers some very granular ideas for the equity holdings in terms of asset classes that may offer some defensive protection at this time. And listen closely, because she shares which asset classes could be defensive right now and which ones are not likely to be. Here's my interview with Nanette Abuhoff Jacobson of Hartford Funds and Wellington Management. All right, Nanette, thanks for being on the show today. Wanted to just jump right in and talk about the thing that is on everybody's mind, which is, of course, the current market volatility. And I'm a former advisor myself. I owned a registered investment advisory firm for many years. And what I'm seeing right now in the industry is a lot of conflicting advice. Everything from some financial planners basically just clinging to the advice of stay the course, which investors could interpret as make no changes at all, to trying to capture returns from top performing asset classes. So what's your take on what you're seeing going on right now and what investors should be doing?
Sure. Well, thanks, Kate, for having me on the show. I agree with you. It's really confusing as to what to do right now. We're facing just this incredibly unusual set of circumstances. We've got higher inflation, higher than we've seen since the 70s. And then, and more recently, some growth fears popping up. And then the Fed is on a course that we've never seen before, of hiking rates and reducing their balance sheet. So liquidity is coming out of the system like we've never seen before. So what do you do amid this volatility? I don't think staying the course is the right advice. In the past, it has been because there was a mentality that buying on the dip is always the right thing to do. The problem now is that most investors' allocations are so concentrated in growth stocks, which is really the tech area. And that's the part of the market that's getting beaten up most because it's so sensitive to higher interest rates. And that's the problem.
And you know what's tricky about that is that those were exactly the stocks that were working for 2 years, more than 2 years, really. But I'm just looking at 2020 and 2021. But that leadership of growth relative to value and other asset classes goes back even further than that. So it seems like people may be kind of shocked by how that's broken down so fast.
Yeah, and it was, the mantra was growth at any price.
Right.
So, buy your tech stocks. They will always go up. That's the, innovation, digitization, that's the future. I'm not saying that that has completely broken down, but I think we've got to be open-minded about a regime change. And so, yes, stay the course makes sense. You don't want to sell all your equities, and certainly not when they're off 15 to 20%. But it does deserve looking at your portfolio and saying, do I have inflation protection? Do I have a balanced portfolio between growth and value, which would include, more energy-related stocks or even commodities? So that's the advice that I'm saying, that you've got to look at your equity portfolio and make sure that it's got exposure to the right economic environment. And we're in a very unusual economic environment right now.
We sure are. And you listed some of those factors that are occurring right now when we first started to talk here. And, one of the things that I wonder about, because in addition to having been an advisor, before that, I actually did the opposite thing, which was the opposite of efficient markets, which was stock trading. And I can see sort of both sides of this, Nanette. And one of the things I'm wondering about is, should investors be kind of doing the thing more that traders do in looking at the events of what's happening right now with their investments, maybe on the charts? Or should they be trying to anticipate where the market may be going, given some of the economic factors that we're seeing?
Yeah, so I think if we can take a step back for a second, the most important thing for every investor is to think about their investment horizon and what are their liabilities. Are those liabilities coming up in the next year, the next 3 months, or the next 5 to 10 years? And that is going to guide your decision as to how much you want to be betting on the markets. I personally think that trading the market is really dangerous. Nobody can get that exactly right. And we're seeing tremendous volatility right now. And, that's going to cost you in transaction costs going in and out. Today the market's up. 2 days ago, the market was down. I really don't think even the smartest among us, present company excluded, can get that right every day. So that I wouldn't do. But I do think that what you want to do is have a philosophy and a framework. And the philosophy is that over the long term, stocks should win, right? That the normal pattern of the economy is to grow. So that's your strategic allocation. But within that, you should be thinking about making tilts within your portfolio based on the current economic environment.
Okay, so specifically then, what does that mean? Because I think as listeners say, okay, that sounds good. I can make some accommodation to the current environment. But what would that mean in practice to tilt? Does that mean overweighting? Does that mean selling things that are not working? How would that really be played out in practice?
Yeah, that's a great question because the implementation is so important in getting that right. So, this is really about being a bit more defensive in your allocations. So I am suggesting to clients that they do reduce some of their equity allocation and to focus on the more defensive parts of the market. So when I look at US versus international, for example, I'm recommending staying overweight US stocks, particularly versus Europe, because Europe is really in the crosshairs of the geopolitical conflict, inflation, et cetera. And I am also suggesting reducing risk by not being overweight emerging markets. So that's a biggie. Everyone has plowed money into China and the rest of emerging Asia, Latin America, and just what's going on with food prices and geopolitical risks because of Russia. I could go on and on, but I just think emerging markets right now are vulnerable. So stick to more, defensive U.S. equities and defensive sectors.
Let me ask you this, because one of the things, obviously, that has also not worked recently is fixed income, at least the way it's expected to work in a strategically allocated portfolio to dampen some of the volatility of equities. Well, we've been in this kind of unusual situation where you've seen fixed income and equities all down simultaneously. Two questions, I guess. How does that affect investor psychology when they see that, and how to avoid it? And the second question is, what should you do in this particular set of market circumstances?
Well, I think it's fair to say that investor psychology would be depressed because, fixed income is supposed to be your hedge. That's what's supposed to protect you in volatile markets and equity sell-offs, and it hasn't done its job. But I think, again, understanding the context of that is important. So the reason fixed income has done so poorly is because it is adjusting to a central bank that has signaled to the markets that they're about to raise rates, and they're about to raise rates a lot. So the market, in fact, has been leading the Fed. I would say the Fed has been behind. And they so much as admitted that. I mean, Chairman Powell basically said, yeah, we were late to controlling inflation. So now they got to play catch up. And that means signaling to the markets that we've got, at least 200 basis points of tightening ahead of us. So, what I've been saying to clients is that the market has priced in a lot already. Rates are up 150 basis points. Mortgage rates are over 200 basis points. And now we're actually seeing signs that the economy is slowing down. So it is possible, and this is, a bit of hope thrown in here. It is possible that, let's say, 3% on 10-year yields might be a plateau in rates, and that it's at least better value than we've seen in a long time. And if you're in corporate bonds, you're looking at, 4.5% yields now. Well, that's a pretty competitive yield compared to equities, if you look at dividend yields, et cetera. So I'm thinking that actually fixed income has some better value, and that it will go back to providing some protection because we're at higher levels and growth is starting to show the effects of Fed tightening.
Not sure what stocks to buy and which to sell? Well, no worries. MarketBeat has you covered. Get the latest buy and sell ratings from Wall Street's top performing, most accurate, and most respected research analysts. That's just one part of what you will receive as a MarketBeat All Access subscriber. You'll also get MarketBeat's new trending stock lists, which monitor social media chatter in real time to help you identify the next GameStop or AMC before you hear about it on the news. MarketBeat All Access also features real-time news, market events, and performance data for your stocks with the MarketBeat portfolio monitoring tool. And you can take a completely risk-free trial for just $1 if you head over to the link we will put in the show notes. You'll get best-in-class stock research tools, performance ratings for Wall Street analysts, real-time news feed, executive support team access, all of this ad-free for just $1 for the first month. Sign up today. The link is in the show notes. So, Nat, given all of that, are you a proponent of the traditional type of allocations? I'll just use 60-40 as the most common example that everybody uses, because you probably heard the same thing I have. In fact, we talked about it on this very podcast, is people saying the 60-40 is dead. What's your take on that?
I think that's an exaggeration. I empathize with our listeners that 60-40 has been a terrible performer recently, but there is no other asset class besides fixed income that plays the same role in a weaker growth environment. So the whole concept of 60-40 is to give you balance when the cycle turns over. And what I think is going to happen is the Fed's going to tighten, or the market will do it for them, and we are going to see slower growth, and that should help fixed income. So maybe it means reducing your allocation to fixed income or decreasing the interest rate risk, but don't abandon it entirely. I think it still plays a role, and it's going to play more of a role when yields are higher. So I think that's hyperbole and makes for a good headline, but I am not of the opinion that you should completely get rid of your fixed income. Because face it, if you're in, what other asset class, you can be in cash. I mean, that is, a more competitive asset class also with yields going up, but it won't give you any capital appreciation the way bonds would or an intermediate portfolio when stocks sell off. So, maybe hold some more cash, reduce some of your very interest rate sensitive fixed income, and then also look for protection. Again, it's that inflation piece that portfolios don't have any exposure. And in my framework, I think having some commodities oriented assets makes sense.
Okay, let's talk about that a little bit, because obviously that's been a top performing asset class. Commodities I'm referring to right now. That's something that's done very well. Some of it's been driven by energy, for example, and I know some of it's been driven by some kind of wild cards like wheat. There's that WEAT ETF that, of course, because of what's going on in Russia and Ukraine, that one has taken off. But say a little bit more about commodities and how investors might include those in a diversified portfolio.
Yeah, so commodities, from the outset, they're a very volatile asset class. As you've said, they've been performed incredibly well over the last, year to date, energy is up 50%. So we're talking about wild rallies there. But what we're saying on the research end is that you've got the geopolitical issues going on. As you said, Ukraine can't get their wheat out of their ports. Energy is threatened because of sanctions, both, the Russia not shipping and the U.S. sanctioning. But we see more structural issues in the commodities market and shortages almost across the board, and particularly in energy and metals. So the idea is that companies are really responding to shareholder pressure not to produce when prices go up. That used to be the self-correcting mechanism. So prices would get really high. CEOs would say, okay, we're going to produce a ton, and prices would come down. Now, because shareholders are demanding capital back, CEOs are getting paid to improve shareholder returns. They're not investing. And so production is down and inventories are really, really low. We're looking at shortages of energy and shortages of a lot of metals. And so that means that we could be in a long-term cycle where commodities continue to perform well. And you could express that in the actual commodities, but there are strategies that use, energy equities and things like that, which are substitutes for commodities.
Okay, so in other words, maybe an energy ETF as your commodity quote unquote exposure. I'm doing air quotes here right now, which nobody can see. Is that the kind of thing you're talking about?
I mean, I'd be very careful about using energy ETFs. I would use I prefer well-diversified baskets of commodities that would include metals and agriculture. And when I've looked at those ETFs, they're very concentrated in one or two names. So I think you got to be really careful about that. And so I would prefer a more diversified basket. And, let's not forget inflation protected bonds. There are tips that could do well in that environment. And frankly, if we have stagflation, gold, I'm not a gold bug. I'll use air quotes too, my invisible air quotes. But, gold is one of the few asset classes that can protect you in a stagflationary environment.
Mm-hmm. Which is great that you point out, because I think a lot of people, you hear mixed things about gold. Sometimes you hear, well, that's not going to protect you in an equity market downturn, but you're making a very specific case for a stagflation environment that is kind of different than just an equity market downturn, isn't it?
Exactly, because remember, we've got two different kinds of, well, there are four different economic environments that I consider. There's nirvana, which is that growth is great and inflation is low. I think we can say that we are probably not in that environment today. And then there are two inflationary environments. There's inflation with growth and inflation with weak growth. And higher inflation, weaker growth is stagflation.
Right.
So, we've got that dynamic right now. And the question is, are we now moving from that dynamic and transitioning to a more recessionary dynamic? Because the Fed is really putting the pedal to the metal on rate hikes and quantitative tightening. So I think you've got to be straddling some of these environments and making sure that you've got the asset classes that respond positively in those two different environments.
Let me ask you a follow-up question on that, and it's something that you had written me earlier in some emails, how to implement some of these changes in a portfolio. I know we covered that a little bit a few minutes ago, but the question I have now is regarding just kind of willy-nilly or drastic changes that you might make. And the intention is to reduce risk, to preserve capital, but there is a danger that you might miss the rebound, isn't there? So how do you avoid that?
Yeah, no, that's a great point. And when I've done the research on rebounds, the reality is that if you make wholesale changes and, sell your equities, you become a forced seller, which is like a terrible position to be in. And sadly, that's what happened in the financial crisis in 2008 to a lot of people. And what happened after the financial crisis is that literally, like within the first few weeks of the rebound, most of the gains were made. So the lesson we learned is you may be smart enough to avoid losses, but you won't be smart enough to get back in time for the rally. And the rally can happen so quickly and so dramatically that you really don't want to miss that. So that's why, as I said at the beginning, at this point, you don't want to sell all your equities or, go from 60-40 to reduce, by 10, 20%. But you can, on the margins, change your sector allocation. So switch some of that tech exposure to, dividend paying stocks.
That's it, right?
Take your international exposure and move it back to US equities. Take your, if you have a lot of credit risk in bank loans or high yield, reduce that risk and go into mortgages and high grade corporate bonds. Add some cash.
Folks, there is your allocation plan right there. I hope everybody was listening and took some notes on that, because Nanette told you exactly what to do in this environment to position your portfolio so you don't miss the rally, which will inevitably occur. I know it's easy for everybody to get kind of discouraged and think things will never get better, especially because the news continues telling us that all the time. But there will be another rally, won't there? And we need to be ready for it.
Yes, there will be, and that's the good news.
It absolutely is. Hey, Nanette, thank you so much for joining the show today. Tell the listeners, if they're interested in what you're doing, how they can find you.
Sure. So I'm the global investment strategist at Hartford Funds, and I work at Wellington Management Company. And you can find my materials on the Hartford Funds website. I publish insights every month and a quarterly publication every quarter. And we're actually doing a webinar at the end of June if folks would like to join. And in that case, they should take a look at the Hartford Funds website and see if they can contact a representative from there.
Okay, and we will link all of that up in the show notes. Hey, thanks again, Nanette. Really a pleasure to have you on the show today, and I appreciate your insights.
Thanks for inviting me, Kate. It was my pleasure.
Thanks again for listening to the MarketBeat podcast. Do not forget to subscribe on Apple Podcasts, Spotify, Stitcher, Google, anywhere else you get your podcasts. And you will also find us on MarketBeat.com. If you enjoy the content here, please give us a 5-star review so others can also find all the great interviews and market insights that we bring to you each week. Also, did you know that MarketBeat has a YouTube channel? We sure do. The podcasts are there, as well as tips for getting the most out of MarketBeat and becoming, as always, a better investor or trader.